So imagine trying to sell, a mountain of obsolete, rusted military tanks left over from a border conflict back in the 1970s.
Right. You definitely aren't putting those on eBay.
Exactly. I mean, you can't just list a fleet of tanks on Amazon Prime and offer 2-day shipping.
No, probably not a great idea.
Or think about a literal geological block of iron ore sitting beneath the earth in Odisha. Where do these things actually go to change hands?
Well, they go into this entirely invisible digital ledger, and it's a ledger that moves trillions of rupees a year.
Yeah, and you have probably never even heard of the company running it.
It really is the ultimate hidden layer of the economy.
Yep.
I mean, we spend so much time talking about consumer tech, the apps on our phones, food delivery algorithms.
Right, the stuff we interact with every day.
Exactly. But the infrastructure that actually liquidates the physical world, the old trains, the mineral rights, the excess government coal, all of that operates entirely out of sight.
Which brings us to our topic. Welcome to the deep dive. Today we are exploring MSTC Limited. I've got this huge stack of financial reports, market analysis, and operational roadmaps right here. And our mission for you listening is to unpack how this entity became the digital gateway for India's industrial economy.
It's a fascinating transition.
It really is. And we should probably establish right up front, MSTC is a mini Ratna Category I central public sector enterprise.
Yeah, and I should probably jump in there, because if you aren't familiar with Indian corporate governance, well, mini Ratna sounds like just complete corporate jargon.
It does sound a bit mysterious.
Right. So in India, state-owned companies, public sector undertakings, or PSUs, they're graded by the government based on their profitability and their net worth.
Okay.
So achieving mini Ratna status is essentially the government taking the training wheels off. It grants the company's board of directors significant financial and operational autonomy.
Meaning they don't have to ask permission for everything.
Exactly. They can make investments, enter joint ventures, restructure all, without needing to ask a ministry for approval every single time.
So they're owned by the government, but they're expected to hunt and operate much more like a private corporation.
Precisely. They have a profit motive, but they have a government DNA.
Which, that brings us to their origin story, because I think it explains so much about how they operate today.
Oh, absolutely.
If you look at their foundation back in 1964, obviously there were no servers, right? There were no digital ledgers.
Definitely not.
They were established for a highly specific, totally physical purpose. They were the designated regulator for the export of ferrous scrap.
Right. They were what was known as a canalizing agent.
A canalizing agent.
Yeah. Think about the economic environment of the 1960s in India. The government wanted strict control over raw materials.
Right.
So if a factory wanted to import or export metal scrap, they couldn't just call up a buyer in London or Tokyo.
They couldn't just negotiate a private deal.
No, the law dictated that every single transaction had to be channeled or canalized through MSTC.
Wow. I'm just picturing rooms entirely full of paper, rubber stamps, carbon copies, and just a terrifying amount of bureaucracy.
Oh, absolutely. It was a complete physical choke point. You had inspectors physically verifying the weights of rusted steel, administrators processing letters of credit, endless physical audits. I mean, they were the absolute gatekeepers of the physical scrap trade.
But the wild part is, what we're looking at today is an entity that took that bureaucratic authority and somehow morphed it into an e-commerce behemoth.
Yeah, the pivot is incredible. Today they handle e-auctions, bulk commodity trading, and even end-to-end vehicle scrapping.
Right. So to understand how a company goes from stamping paperwork for rusted steel to handling hundreds of billions of rupees digitally, we really have to look at the actual mechanics of what they do today.
We do.
The reports break their business down into 3 core verticals. We've got e-commerce, trading, which they sometimes call marketing and recycling.
Let's start with the engine room, which is the e-commerce division.
Yeah, let's get into it.
And we really need to redefine e-commerce for this specific context. When we talk about e-commerce, people usually think of, shopping carts and credit card gateways.
Like buying shoes online.
Exactly. MSTC's e-commerce is entirely about high stakes, high volume public asset disposal and procurement.
So let's get into the mechanics of that. If a central public sector enterprise, say the Steel Authority of India, if they want to auction off thousands of tons of obsolete machinery, how does that actually happen on MSTC's platform?
Well, it starts with the verification of the cataloging. MSTC doesn't just host a website, right? They provide the entire operational framework.
Okay.
The seller uploads the detailed specifications, the metallurgy reports, or the geological surveys if it's a mining block.
So they gather all the hard data.
Right. Then MSTC's system structures this into a legally binding auction framework. They manage the earnest money deposits, meaning buyers have to put down serious cash just to participate.
Oh, so that weeds out the bad actors.
Exactly. Completely filters out anyone who isn't serious.
So they act as like an escrow and verification layer before the bidding even starts.
They have to. Think about the stakes here. In a forward auction, where the price goes up, like selling a coal block, you might have multinational corporations bidding against each other.
Right. Billions on the line.
Exactly. The digital handshake has to be absolutely flawless. The encryption has to ensure that no bidder can see another's bid prematurely.
To prevent cartels or bid rigging.
Precisely. And it goes the other way, too. They run reverse auctions for procurement.
Wait, explain the reverse auction mechanism, because that's interesting.
Sure. So if a state government needs to procure, say, 10,000 specialized hospital beds, they don't want the highest price. They want the lowest price.
Right. They want to save taxpayer money.
So MSTC sets up a reverse auction where verified suppliers bid the price down in real time.
Oh, wow.
Yeah. And the software ensures that all suppliers meet the technical qualifications before they're even allowed into the bidding room.
That's fascinating. It completely sanitizes the public procurement process, removing all those backroom deals and paper tenders that, used to define government buying.
Exactly. It forces total transparency.
The best analogy I could come up with while reading through all this is that MSTC functions sort of like an API for the physical world.
Oh, I like that.
Yeah, because in software, an API lets two different programs talk to each other seamlessly. MSTC is the API between the government's physical assets and the private sector's capital.
That is a very accurate way to frame it.
A few keystrokes in Delhi trigger a legal transfer of ownership for a fleet of decommissioned buses in Mumbai, complete with all the compliance, the tax calculations, and the financial routing.
Yes. And to strengthen that API, they don't just run the auction portal. They actually build custom enterprise resource planning, or ERP software, for these government bodies.
Really? They build the back-end software too?
They do. They integrate their auction engines directly into the finance dashboards and inventory management systems of the state governments.
Oh, wow.
Yeah. Once you embed your software that deeply into a government ministry's daily workflow, you become incredibly difficult to replace.
That makes total sense. You're part of the furniture at that point.
Exactly.
Okay, so that covers the e-commerce side. The second vertical is trading, which, as I mentioned, they sometimes refer to as marketing in their reports. And this feels like a real throwback to their 1964 roots.
It does. Because here, they act as a bulk procurement agent.
Right.
It is a fascinating hybrid model.
Yeah.
In the trading vertical, MSTC acts on behalf of what they call principals. These are usually enormous steel plants.
Okay.
Let's say a steel plant needs a continuous, staggering supply of heavy melting scrap or coking coal or iron ore billets.
Just massive quantities to keep the furnaces running.
Exactly. The plant wants to focus on manufacturing steel. They do not want to deal with the nightmare of global supply chain logistics, foreign exchange hedging, and import compliance.
So they just outsource the headache to MSTC.
That's it. MSTC goes out into the domestic and international markets, finds the suppliers, negotiates the bulk pricing using their vast institutional leverage, procures the materials, and arranges the financing and delivery.
They act as the ultimate intermediary.
Precisely.
But the third vertical is the one that really caught my eye, honestly, because of its direct environmental impact. Recycling.
Yes, the recycling pivot is huge.
They have a joint venture called MMRPL, which they formed with Mahindra Excello. And through this, they launched India's very first registered vehicle scrapping facility.
This is a really critical pivot. India has been aggressively rolling out a national vehicle scrappage policy.
Right.
The goal is to get highly polluting end-of-life vehicles off the roads.
Yeah.
But you can't just mandate that without providing the physical infrastructure to actually destroy those vehicles safely.
Right. You can't just tell people to junk their cars if there's no place to junk them. And this isn't just a digital auction. They are actually getting their hands dirty here.
Very dirty. In this vertical, they aren't just the digital broker. Through the joint venture, they run the physical plants.
Wow.
And the mechanics of modern vehicle scrapping are intense. You don't just crush a car. You have to safely drain and dispose of highly toxic battery acids, engine oils, refrigerants.
Stuff you do not want in the groundwater.
Exactly. And then you have to separate the non-ferrous metals like aluminum and copper from the heavy steel. You have to deal with the plastics and the glass.
So they deconstruct the vehicle, recover the raw materials, and then presumably feed those materials back into their own e-commerce and trading networks to sell back to the steel plants.
You've got it. It is a closed-loop system. They facilitate the initial life cycle of the industrial materials, and now they are physically managing the end-of-life stage, turning that waste back into tradable commodities.
Okay, so we have the API for government auctions, we have the bulk trading intermediary, and we have the physical vehicle recycling.
Right.
How do they actually monetize all of this? Because if they are an API, they shouldn't be holding the risk of owning mountains of coal.
They don't. Their revenue model is just a masterclass in risk avoidance. In the e-commerce vertical, it's entirely a fee-based system.
Okay.
They charge a transaction or auction fee. It could be a flat platform fee or a percentage of the final clearing price.
So the government entity offloading the surplus pays MSTC for the secure execution.
Exactly. They also pull in licensing fees for that custom ERP software we mentioned earlier.
It's essentially a highly specialized toll booth. If you want to move capital and assets safely on the government highway, you pay the toll.
That's a great way to put it. And in the trading vertical, they operate on a buy-sell spread.
Meaning?
They lock in a bulk price from a global supplier and sell it to the principal steel plant at a slightly higher price, capturing the margin. They also charge direct intermediation fees.
Makes sense.
And then in recycling, they charge the vehicle owner a scrapping fee and then generate revenue by selling the extracted metals.
The business model is incredibly clean. But the sheer scale of the sandbox they are playing in is what really requires a deep dive here. The reports lay out their total addressable market, the TAM, meaning the total value of all the transactions they could theoretically facilitate, and the numbers are almost hard to fathom.
They really are.
We are looking at a 15 to 20 trillion rupee playground.
And for listeners more accustomed to dollars, that is roughly 180 to 240 billion US dollars in transaction value.
It's just an astronomical number.
But we shouldn't just throw out a trillion rupee figure without exploring the mechanics of what makes up that number. It's built on 3 distinct buckets of economic activity.
Okay, let's break those buckets down. Bucket number 1 is e-auction and public asset disposals.
Right.
This encompasses all the scrap, the surplus machinery, the coal blocks, and the spectrum auctions that the Indian government and PSUs sell every year. The reports peg that specific activity at a 5 to 6 trillion rupee market annually.
Then you have the second bucket, e-procurement and bulk commodities. This is the flip side of the first bucket.
Buying instead of selling.
Exactly. This is the staggering volume of raw materials, steel, petroleum, coking coal, that the government and enormous corporations procure to build infrastructure.
And what's the value there?
That adds another 6 to 9 trillion rupees to the TAM.
Wow. And the final bucket is the recycling and scrap management sector. India generates somewhere in the neighborhood of 10 to 12 million tons of scrap annually.
A huge amount of material.
Yeah. Managing, trading, and recycling that volume is valued at roughly 4 to 5 trillion rupees.
So you add the public disposal, the bulk procurement, and the scrap recycling, and you arrive at that 15 to 20 trillion rupee total market.
But here's the data point that should make anyone paying attention sit up straight. MSTC is the undisputed dominant player in this space, yet they currently only serve about 3 to 4% of this total market.
Yeah, that's the kicker.
Let me contextualize that 3 to 4% because it still represents an enormous amount of money. In just the first half of the 2024-2025 financial year, MSTC handled over 476 billion rupees in transaction volume.
In just 6 months.
Right. They are moving nearly 500 billion rupees in half a year, and yet they're only capturing a tiny slice of the actual market.
Which leaves roughly 96% of this market open.
Now, I have to push back here.
Okay.
If I'm a venture capitalist looking at a $240 billion market with only 4% digital penetration, I am throwing unlimited funds at startups to disrupt this.
Absolutely, you would think so.
Right. Why hasn't a Silicon Valley clone or a flashy tech startup wiped them out? Why isn't there an Uber for government scrap?
Because you have to look at the mechanical reality of that open 96%. It is not a clean, waiting to be disrupted market.
What do you mean?
It is deeply fragmented, informal, and largely analog. Let's just look at the scrap sector. Over 70% of India's scrap market operates in the unorganized sector.
What does that actually look like on the ground?
It looks like thousands of local independent scrap dealers operating out of small yards. They're using analog weighing scales, cash transactions, and handwritten ledgers.
So no digital footprint at all.
Right. They don't have GST compliance software integrated into their daily operations. They have regional relationships and local logistics networks.
I see.
So a tech startup can build a beautiful user interface, sure. But how do you force 1,000 independent yards in rural Punjab or Tamil Nadu to suddenly adopt a centralized, transparent digital ledger?
You can't just email them an app and expect them to change their entire business model.
Exactly. The friction of behavioral change in the physical world is immense.
Okay, but what about on the government side? Surely state governments want to be digitized.
They do, and there are strict mandates pushing for it.
Yeah.
But local municipal bodies still often rely on highly fragmented, localized tender processes.
So it's a slow burn.
It is. However, this is where MSTC's advantage kicks in. There are structural growth drivers forcing this analog market into the digital light.
Yeah, the reports mention a projected 5 to 10% compound annual growth rate for this sector. And that growth isn't relying on consumer whims, it's mandated by policy.
Right. The National E-Governance Plan is actively pushing to increase digital transaction penetration from its current 30% to over 70% by 2030.
Wow, so the government is forcing the issue.
Furthermore, you have to factor in the sheer physics of India's macroeconomic trajectory. India is undergoing an infrastructure boom of historic proportions.
Bridges, highways, airports, high-speed rail.
Yes, and every single ton of steel poured into a new project generates industrial scrap. Every old structure torn down generates scrap.
Right.
Urbanization in India is projected to leap from 35% to 50% by 2040. Demographic experts and economists estimate this will naturally increase scrap generation by 40 to 50%.
So the physical pie of materials is getting much larger, and the government is legally mandating that a larger slice of that pie must be handled digitally.
Exactly.
MSTC doesn't even need to invent a new product, really. They just have to stand in the river with a net while the current speeds up.
That's a perfect image. They are positioned right at the confluence of physical industrial growth and mandated digital compliance.
But that brings me back to my startup question. Even if the market is tough to digitize, why MSTC?
Right.
I mean, if a massive conglomerate decided to spend $1 billion to build a competing, ultra-secure platform, what are the defensive walls, the moats, that keep MSTC protected?
The deepest moat they have is something capital literally cannot buy. It is their monopolistic statutory rights.
Ah.
Because they are a mini Ratna PSU, with the government of India holding a 64.75% stake, they are legally mandated as the primary channeling agent for specific state-owned asset disposals.
So it's not a preferred vendor contract that can be lost to a lower bidder.
Yep.
It's a legal lock. I was trying to think of an analogy. It's not a VIP nightclub where they just happen to have the best bouncers.
Right.
It's more like they own the only bridge to an island where all the government's wealth is stored, and a federal law dictates that no one else is allowed to build a second bridge.
That is a much more accurate framework. If a state government discovers a new bauxite mine and needs to auction the extraction rights, they don't put out a request for proposals for software platforms.
They don't shop around.
No, they are routed directly through MSTC.
Ah.
And you can see the financial impact of this monopoly.
How so?
Well, if you look at their historical data, when they were heavily focused on just bulk trading, where there is private competition, their operating margins were in the single digits.
Okay.
Today, driven by this mandated e-commerce auction space, their operating margins have surged to around 36%.
36%.
Yeah, they capture higher value fees because they aren't engaged in a race to the bottom on pricing. They don't have to discount their services to win the government's business.
But surely it isn't just a government decree keeping them afloat. If their software was terrible, the government ministries would eventually revolt, right?
You'd hope so.
The reports dedicate a lot of space to their technology infrastructure. They serve over 150,000 clients globally, and they highlight a track record of 0 major security breaches.
And we really need to dwell on that zero breach record, because in the context of government asset auctions, security is not a feature. It is the entire product.
Right, it's the foundation of everything.
Imagine the chaos if a platform auctioning a multi-billion rupee coal block was hacked.
It would be a disaster.
If bids were exposed, if participant identities were leaked, the entire legal validity of the nation's resource allocation would just collapse.
So how do they actually secure it? We are talking about preventing state-sponsored hackers from manipulating mineral rights here.
They utilize military-grade cryptography, highly redundant server architectures, and incredibly strict access controls. They have spent over 2 decades since launching their first digital portal around 2002, just stress testing this infrastructure.
So it's battle-tested.
Exactly. A private startup cannot replicate 2 decades of proven, flawless execution in a high-stakes government environment overnight, no matter how good their coders are. Trust is a lagging indicator. It takes years to build.
Yeah, that makes sense. And the third moat seems to be the classic marketplace network effect, the liquidity advantage.
It is the ultimate chicken and egg dynamic, but it's solved by a government mandate.
How so?
Well, in a normal marketplace, buyers congregate where the most supply is, and sellers list where the most buyers are.
Right.
Because MSTC is mandated to list the government's colossal supply of coal, scrap, and minerals, every serious industrial buyer in India simply must have an account on their platform.
If you run a steel plant, you literally cannot afford to not be on MSTC.
Right. So if a competitor somehow gets permission to launch an alternative portal, they face an insurmountable hurdle.
How do you get anyone to show up?
Exactly. How do you attract the Tata Steels and the Jindals of the world to your platform when you don't have the government coal they need?
You don't.
And how do you convince private sellers to list with you when MSTC already holds the captive attention of every major buyer?
Yeah.
The ecosystem just reinforces itself.
Okay, so they have an impenetrable legal mandate, military-grade security, and a self-reinforcing network of buyers and sellers. Moats are wonderful in theory, but how efficiently does this digital machine convert that dominance into cash? Let's dig into the economics.
The financial profile of MSTC is a textbook demonstration of software operating leverage.
Operating leverage, let's explain that.
Sure, in a traditional physical business, if you want to double your sales, you have to build another factory, hire twice the staff, and buy twice the raw materials. Your costs scale linearly with your revenue.
Right, making more costs more.
But a digital marketplace completely breaks that physics.
Because it's just code.
Exactly. Once MSTC has incurred the fixed costs to build the secure server architecture, write the auction algorithms, and establish the compliance frameworks, the marginal cost of hosting one additional auction is practically zero.
Whether they option 100 obsolete trucks or 10,000 trucks, it's essentially the same effort for the servers.
Yes. Their baseline operating costs remain largely static, while their fee revenue scales proportionally with the volume.
And that operating leverage shows up vividly in the numbers. Looking at their projections for the first half of the 2026 financial year, and these are forward-looking estimates in the reports, obviously, their total income is projected to hit nearly 1,960 crore rupees, with a net profit crossing 934 crore rupees.
Generating over 934 crore in profit on roughly 1,960 crore of income is a staggering margin.
It's basically a 50% profit margin.
It is, and it's only possible because of that asset-light model. They don't warehouse the coal, they don't take title to the scrap steel, they assume almost zero inventory risk.
They simply extract a toll as the value passes through their digital infrastructure.
Precisely.
And because they don't need to sink a vast amounts of capital into physical warehouses or inventory, their free cash flow is tremendous.
It is.
The reports note they pay out a dividend of 54.1%. They are returning more than half their profits directly to shareholders.
It is a phenomenal cash engine. But it is not without friction. If you read the fine print in their cost structure, the biggest anchor dragging on their margins isn't technology costs or marketing.
Right.
It is their own workforce.
Yeah, this stood out to me as a huge contradiction. They run a highly efficient, infinitely scalable tech platform, but their personnel costs look like a bloated bureaucracy.
It's the PSU reality.
In the 2024 financial year, their standalone profit before tax actually dropped by 9%. And the culprit wasn't a loss of clients. It was a 20% year-over-year surge in employee costs. Why are their salaries spiking so aggressively?
This is where their PSU DNA becomes a serious liability. MSTC operates under rigid industry-wide wage structures dictated by the government.
Ah, so they don't set their own pay scales.
No. Periodically, the government initiates comprehensive pay revisions for public sector employees across the board. MSTC cannot opt out of that. They do not have the agility of a private tech firm that can optimize headcount, adjust compensation structures based on individual performance, or utilize stock options in the same way.
So even if their tech platform requires fewer people to run efficiently, they are locked into legacy compensation frameworks?
Yes.
And I imagine they can't just casually raise their fees on government ministries to cover the difference.
They really cannot. Their fee agreements with state and central ministries are often locked in through long-term memorandums of understanding.
So they have a ceiling on what they can charge.
Exactly. They face a ceiling on what they can charge, while their floor for fixed personnel costs is periodically hiked by government mandate. It creates a structural squeeze on their otherwise excellent margins.
Now, while we were looking at the balance sheet, there is a number here that could be incredibly misleading to a casual observer.
Oh, the Q3 spike.
Yes. In the third quarter of the 2025 financial year, they reported a 120% surge in net profit. If you just read the headline, it looks like they suddenly doubled the efficiency of the core auction business overnight.
Context is absolutely crucial there. That surge was an anomaly, not a structural shift.
Okay, explain what happened.
It was driven primarily by a one-time exceptional gain. MSTC sold a subsidiary company known as FS&L Ferro Scrap Nigam Limited.
Okay.
The sale generated a sudden infusion of over 273 crore rupees.
It's a nice cash windfall for sure, but it doesn't mean their core e-commerce engine is suddenly twice as profitable.
Exactly. You have to strip out that exceptional gain to understand the true trajectory of the business, which is steady, high-margin growth, but constrained slightly by those rigid wage dynamics we just talked about.
All right, so we have a clear picture of the present. They dominate the trade of physical scrap, coal, and minerals. But those are legacy industries. As a digital platform, how do you evolve?
Right.
What is the roadmap for a company that already controls the government's physical assets?
This is perhaps the most strategic pivot in their history. They are expanding from auctioning physical mass to auctioning regulatory compliance.
Okay, that sounds like corporate speak. What does that mean?
They are stepping into environmental exchanges.
Ah, this is brilliant. The reports detail that MSTC has been mandated to build India's first CPR exchange carbon performance rating.
Yes.
And concurrently, they have launched the CPCB EPR trading portal.
We should definitely unpack the acronyms. EPR stands for Extended Producer Responsibility. It is a regulatory framework primarily aimed at managing plastic waste.
Let's explain the mechanics of how this actually trades, because it's a bit abstract.
Sure. Say a major consumer goods company produces thousands of tons of plastic bottles. The government mandates that they are legally responsible for ensuring a certain percentage of that plastic is recycled.
Okay, they have a quota.
Right. If the company invests heavily in recycling infrastructure and actually recycles more plastic than the government mandated, they earn a digital certificate representing that surplus effort.
Got it. But if a competing company fails to meet their recycling target, they are facing severe regulatory fines.
Exactly. So the company that failed buys the surplus certificate from the company that succeeded, allowing them to balance their compliance ledger.
It turns environmental responsibility into a fluid, tradable commodity. And MSTC is building the digital trading floor where those certificates change hands.
And I would argue that MSTC is the only logical choice to build this.
Why is that?
Well, if the government is going to construct a brand new, highly sensitive market that will dictate the compliance status and the financial liabilities of thousands of major corporations, they need absolute trust.
Right.
A venture-backed green tech startup might have a slicker app, sure. But do they have 20 years of zero-breach security handling government assets? No.
So MSTC already has the encrypted infrastructure.
They have the infrastructure, the compliance frameworks, and, crucially, the pre-existing relationships with all the heavy industries that will be doing the carbon and plastic trading.
They are just swapping out a digital certificate for a ton of iron ore. The auction engine running underneath is identical.
Exactly.
And speaking of infrastructure, they are also making a major play to monetize the physical hardware that runs all of this. They are building a vast data center in Delhi, slated to be operational in the 2026 financial year.
This is a really fascinating attempt at efficiency. Running a platform that handles 150,000 clients and billions of rupees requires vast server capacity.
Obviously.
However, auction traffic is bursty.
Bursty!
Yeah. You might have immense server load during a high-profile coal auction and then relatively low load the very next week.
Right.
To guarantee uptime during the spikes, they have to maintain a large surplus of computing power.
So they have servers just sitting around waiting for traffic spikes.
Right. So rather than letting those secure servers sit idle, they are opening the doors to external clients. They are essentially trying to become a boutique, highly secure cloud hosting provider.
They are attempting to turn a massive internal cost center server maintenance into a revenue-generating business unit.
Exactly. And alongside this infrastructure push, they're also aggressively moving up the value chain in their core options. You can call it premiumization.
The reports mention they have initiated gold bullion tariff rate quota auctions. Gold. That is a profound leap from organizing the sale of rusted buses and scrap steel.
It requires an entirely different level of financial verification, insurance, and security protocols.
Right.
But if they can successfully establish themselves as the clearinghouse for sovereign gold auctions, it dramatically elevates the total value flowing through their platform, which directly increases their percentage-based fee revenue.
They are also launching a portal called MSTC Realty, moving into the private property and real estate sector.
Yeah, that seems like a deliberate strategy to decouple themselves from the cyclical nature of scrap metal and coal.
They are trying to diversify their revenue streams so that if global steel production slumps, they have carbon credits, cloud hosting, and real estate to balance the ledger.
Smart.
It sounds like an impenetrable fortress. They have the legal mandate, they print cash with zero inventory risk, and they are commoditizing the future of environmental compliance. But, no business is immortal. If we look at the risk factors, what is the torpedo that could sink this ship?
The single most terrifying threat to MSTC is known as GM, the government e-marketplace.
Let's examine this carefully, because earlier we established that their greatest strength was their government mandate.
And that is exactly why it is their greatest vulnerability. GEM is a distinct, overarching public procurement portal developed by the central government.
Okay, so it's a competing government platform.
Essentially, yes. It was initially designed for standardized, everyday goods, think office supplies, computers, basic vehicles. MSTC retained the mandate for the highly complex, specialized auctions like mineral rights and heavy scrap.
But the threat is centralization.
Yes. The government is continuously pushing to consolidate its digital operations. If a policy directive is issued that mandates all government transactions, including the complex scrap disposals and asset auctions, must be routed exclusively through the GEM portal, MSTC's primary moat evaporates overnight.
Wow. So their greatest advantage is really just a lease. They live in a magnificent fortress, but the government holds the deed, and the landlord could change the locks tomorrow if the political winds shift toward total centralization on GEM.
It is an existential regulatory risk. Now, it hasn't happened yet because the technical complexity of auctioning a customized geological mining block is vastly different from buying 1,000 laptops.
Right, GEM isn't built for that yet.
Exactly. But the specter of that policy shift hangs over every long-term projection.
Beyond the government changing the rules, what about straightforward market competition? As they diversify, they're stepping out of their protected sandbox.
The data center is a perfect example of that. Providing secure hosting for internal government auctions is one thing. Trying to sell cloud services to external corporate clients means you are suddenly in the ring with apex predators.
You are going head-to-head with Amazon Web Services, Microsoft Azure, Google Cloud.
And MSTC has a fraction of the capital and capacity of AWS.
Right. AWS has ecosystems of developer tools, global redundancy, massive sales operations.
Exactly. MSTC risks sinking heavy capital into this Delhi data center and failing to attract enough private clients to make it profitable, leaving it as an expensive, underutilized asset.
And even in their trading vertical, they act as a bulk middleman. But private commodity brokers are incredibly agile. They operate on razor-thin margins and don't have to deal with the bureaucratic overhead of being a PSU.
Which leads to the third major vulnerability: macroeconomic cyclicality.
Right, boom and bust cycles.
MSTC's revenue is inextricably linked to the physical volume and the market price of the commodities on its platform.
If the global economy contracts, construction halts. If construction halts, steel production plummets. If steel production plummets, the demand for bulk raw materials and the generation of industrial scrap both dry up.
Furthermore, they charge percentage fees based on the final auction value. If the global commodity price of iron ore crashes, the absolute value of the auctions drops significantly.
MSTC does the exact same amount of digital work to host the auction, but their revenue takes a massive hit simply because the underlying commodity lost value.
They don't hold the inventory, so they don't take the capital loss, but they absolutely suffer the revenue contraction.
And finally, there is a risk inherent in their corporate structure: litigation and compliance. When you are a publicly listed entity that is also a government enterprise, the scrutiny is intense.
Yeah, very intense. A minor administrative lapse can trigger disproportionate consequences. The reports highlight a very specific recent incident. MSTC was officially fined by both the National Stock Exchange and the Bombay Stock Exchange. The violation was non-compliance with SEBI and the SEBI, the Securities and Exchange Board of India listing regulations regarding the specific composition of their board committees.
I read that they failed to have the requisite number of independent directors, specifically a woman independent director, which is a strict regulatory requirement for listed companies.
They have since rectified the issue and made the necessary appointments, but it illustrates the friction. A private startup in a similar situation might receive a private warning or quietly restructure.
But a listed PSU faces immediate financial penalties and public reprimands.
Exactly, which can rattle institutional investors and damage market confidence. The operational environment is incredibly rigid.
Which makes me wonder about their balance sheet strength. If they are facing the looming specter of GEM centralization, the threat of AWS in the cloud space, and the cyclicality of global steel, how thick is their armor?
Their armor is made of cash. The financials show they are sitting on a surplus cash reserve of roughly 4 billion rupees.
4 billion rupees. That is a formidable safety net.
And they must protect it fiercely. If the GEM portal slowly starts eating into their public auction volumes, MSTC will need significant capital to pivot their sales operations entirely toward the private sector.
Right.
If their recycling joint venture, MMRPL, continues to burn cash as the physical scrappage infrastructure slowly scales across the country, they need that reserve to absorb the short-term losses. That 4 billion rupee buffer is their insurance policy against the structural vulnerabilities of their own business model.
It is a remarkable balancing act. We have spent this deep dive mapping out an entity that completely defies the standard tech narrative. Let's trace the arc of what we've uncovered.
Okay.
We started in 1964 with a bureaucratic canalizing agent drowning in paperwork, regulating the export of rusted ferrous scrap.
And over 6 decades, they leveraged that physical choke point into a digital leviathan. They sit at the center of a 15 to 20 trillion rupee market, facilitating the digestion, trading, and recycling of a nation's physical infrastructure.
They constructed an impenetrable defensive moat built on statutory government mandates, military-grade digital security, and an inescapable network of heavy industry buyers. They process hundreds of billions of rupees with zero inventory risk, generating tremendous free cash flow.
Even as they wrestle with the friction of legacy PSU wage structures.
Exactly, and they are aggressively attempting to future-proof that model. They are moving beyond physical scrap to commoditize environmental compliance with carbon and plastic exchanges, launching data centers and auctioning sovereign gold, all while navigating the existential regulatory threat of overarching government centralization and the cyclical whims of global commodity markets.
Whether you are working in tech, manufacturing, or just watching India's infrastructure boom, understanding MSTC gives you an X-ray view of how a nation's physical assets are digested, traded, and recycled in the digital age. It is the invisible plumbing that ensures the machine keeps running.
And as we wrap up, I want to leave you listening with a thought that isn't explicitly detailed in the financial reports, but feels like the logical, perhaps inevitable conclusion of their business model.
What's that?
Well, we have spent an hour talking about how MSTC functions as the secure digital poll booth for decades of government transactions. They don't own the coal, the steel, or the scrapped vehicles.
Right.
But they do own the data.
Oh.
They hold the historical digital keys to millions of transactions. They know exactly how much every block of minerals was valued at, the seasonal fluctuations of scrap demand, the bidding behavior of every major industrial player in the country, and soon, the granular carbon compliance metrics of the entire corporate sector.
That's a staggering amount of intelligence.
If you possess a secure platform that has processed billions of data points on the exact clearing price of a nation's physical reality, what happens when you start training predictive AI models on that proprietary historical ledger?
Why?
They wouldn't just be a digital auction house facilitating trades. They could evolve into the ultimate, indisputable oracle for the true predictive value of a nation's resources.
That is a fascinating implication. The platform itself becomes more valuable than the assets it trades.
Something to think about the next time you see a highway being poured or an old industrial plant being torn down. Thank you for joining us on this deep dive. We will catch you next time.